Good morning, traders. So I had one of my hedge trades that I like to put on in my IRA go off. I closed it here. It expired. Well, the options that were left in it expired on Friday. So I want to get another one set up. Now, again, keep in mind the premise here, and I'm just sharing this with you because I've had people ask me about it. This is not a trade anybody should be making with live money unless they experiment with it, they do their own research, they fully understand what this is all about. But again, the goal here is to act as somewhat of a hedge in a long equity portfolio. So I have an IRA that has a bunch of long stock in it. Now, while it's long stock, I will also say that a lot of that stock I do covered calls on. So it's not fully long. It already has a little bit of a hedge by doing all those covered calls in there. But I also, I guess I should say those covered calls will make money in a market drop, but I want to have some of these on that will also be slightly negative delta that will make money in a market drop. And they're making money through theta decay. These are two that are currently out there. So this is the one that I am following with the class. This is the one that I shared with the class. I've done nothing with this since I've put it on. This has just sat there. At some point, I'll start rolling in wings, probably another maybe 3-4 weeks, somewhere in that general range. But it's just kind of sitting there, chunking away, doing its decay thing. It has very little upside risk, which I could easily adjust out if the market were to rip up substantially. And it is carrying negative delta, which of course is what I'm looking for here. It's a negative 10 delta in this case. Not that there's any magic behind the specific number. I just want negative delta, so if the market sells off, at least for a period of time, this will likely gain a little bit in value. Same story over here. So this one is about a month later, actually a couple weeks later. It's not quite a month later in time, but I haven't really done anything with this one yet either. But you can see this one's January. One of them just rolled off here for September. So I want to go out and get another one established. So that's what I'm doing here. You'll also note that these two, by the way, are in SPX. So I also like to have a little bit of variability in there. So this one I'm going to do in RUT. So if I come take a look at a chart in RUT, this is kind of the big picture, going back almost a year that I'm looking at. And this is where the RUT is currently. It's right smack in the center of a big wedge. So my expectation for the foreseeable future, and here I'm looking out a little bit further, of course, is that it's probably going to stay in this general red wedge pattern between, call it 1725 up to, call it 2000. So I'm kind of playing for that range. Call it 1700 to 2000, just for round numbers. So when I come back and I look at this trade, I've set it up so that if the market were to drop down to 1700, yeah, I'm going to be down a little bit. Now, I'll be down a little bit more because, of course, if I'm in this trade and the market drops that considerable, volatility is going to exacerbate this loss. This line, rather than being down, $500, it could be down here at $5,000 if volatility spikes up significantly. So I need to understand that. I need to know that going in, how this is likely to react in a major market situation. And of course, at that point, if that were to happen and I were to not adjust this at all, it's no longer acting as a hedge. This is now a liability. It's positive delta, and it would be just like the rest of my portfolio, which I don't want. So if that were to happen, if a large drop were to happen through some global event, and fear in the market, this is going to be working against me very, very fast. So I need to know how to adjust that if and when that were to occur. But if we're looking at just normal decay, normal market gyrations, again, down to 1700 is fine, up to about 2000 is fine. If the market were to start to rally up significantly from here, I would end up needing to adjust this. I'm okay carrying this risk to the upside right now. But again, if the market were to start all of a sudden picking up, there's things I would need to do to adjust that. There's a number of different possibilities. I could roll these wings in. I could roll these shorts up, which is going to increase my downside risk. I could roll these shorts up. So there's a lot of different possibilities that I would need to consider if that were to start to happen. So, but for right now, I like the general complexion of this. It is in rut. It is based, this is 180 days out. So it's based out in March 15th. So it'd be a good complement to the other two that I have on right now, in my opinion. I don't need to rush to get into this. You can see price is bouncing around. It was as low as, I think, $9.25, as high as $9.50. Again, we're a ways out, so the bid-ask spreads out there are going to be pretty wide at this point. So what I'm going to do to get into this is I will make this a GTC order in Option Trader's Assistant. I need to switch this to my IRA account, and I don't need to go out anywhere near the current market. Again, I could let this trade set out there for, it might sit there a week or two before it gets filled. And it may take a big market move day one way or the other to where bid-ask spreads, tighten up a little bit, or somebody gets desperate and says, ooh, I really want to get into this position. So it's going to be something like that that's going to get an entry on this. And I am not, just for clarification point, I am not going to be following this trade through. I'll get in it and I'll do my thing with it. The other one that I did open for the class, I will update you as I go in and adjust that at some point. But again, these don't get much action anywhere along the way. So anyhow, I did just want to share kind of the concept of these. Again, if somebody's going to look at this, make sure that you paper trade it first. And yes, it's a long paper trading process. So you're not going to learn quickly on this. Unless you go use, for example, the rollback or on-demand, I think it's called on-demand function in Thinkorswim. You can go and trade these and roll them forward. And I think OptionNet Explorer allows you to potentially do that as well. So anyhow, that's it. Just thought I'd share this so that people have a better understanding of how I put on some of these hedges.